Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Matt Amberson. He's the Principal of Options Research and Technology Services, affectionately known as ORAT. And we also have Joe Cusick. He's a Director of Institutional Education and Business Development over at the Options Industry Council. We're going to talk about my favorite topic, trading options and using options to backtest. Thank you very much for joining us. It's great to have you in from Chicago.
Thank you.
Good to see you, Matt. Joe, let's kick it off with you. Let's talk about this. What are stock and options traders missing by not looking at the options market?
Yeah, you know, when typically you'll see a lot of individuals take a look at charts. That's their forecasting tool. But charts are past. You know, you're looking at history. While it's helpful, it's not giving you a forecast. And so that's why, you know, Matt and I over the years have talked ad nauseum about the fact that you have an implied forecast in an options price. It's implied volatility. And you can use that implied forecast because that's what, when we were former market makers, we used that to say, okay, this is what we're estimating is a potential move in the stock. And you can use that forecast when you start to think about strategy selection, thinking about not only strategy selection, but also what type of opportunity you want to put on, bullish or bearish. It just starts to temper whatever your enthusiasm or it just gives you more transparency.
And it makes perfect sense for binary events such as events or an FDA decision or going into the Fed.
Yeah.
So you'd rather look at something going forward, which is what options are, versus what's already happened with the charts.
Exactly,
right.
Exactly.
But how can non-traders and traders use options to estimate these moves?
Right. I mean, hey, a stock trader, they're not going to look at options. They typically never have. But if you think about it, you have a tool in front of you that can give you a forecast. So if you're talking about an earnings environment, we're in the heart of it right now, okay? And if you're looking at the options marketplace, you don't have to trade them, but you can use them. So for example, let me give you a quick example. I'm going to verbalize this for you a little bit.
Right.
Let's say, for example, you look at a stock that's trading at somewhere around $150. You look at the at-the-money strike. That means that's the same strike price that the stock is trading. So let's say the 150 strike. You take the call and put, and you add those offers up. That's what the marketplace is willing to sell it to you. Then you look at the next strike, call and put, out of the money. So the upper call and the lower put. You take the offers for that. You add those up. So let's say, for sake of example, they add up to $16. You divide that by 2. That's telling you, based on what the options marketplace is priced in, that there's an $8 move being priced in between now and the expiration of those options with a 50% probability. Now, having that type of perspective now gives you context, so that when you look at the chart and you see what it's been doing, now you're getting a context of where it could potentially go, right? And again, it's only a 50% probability, but you know, as Matt will discuss, I mean, you can synthesize that so that you can have a 68, 95% probability of having those.
Well, it's better than 0% and not being able to manage your risk, right?
Absolutely.
All right, so Matt, let's talk about ORATs and how you crunch all of these numbers into earnings. And how does all this math fit into the technology that's being provided with ORATs?
Yeah, Joe talked about a straddle and some option prices and going into an expiration. But now let's say we have an earnings event in between the day that you're trading and the expiration. We have a way to identify very accurately what the option market is expecting for that one-day binary event. And that could be very important. As we've seen some major moves, especially this earnings. And if we could say what the option market was anticipating and compare what actually happened, there's a lot of good information in that. And that's what we do at ORAT. We're able to really say with conviction what we think the option market is saying about that one-day move in a stock.
And these are pretty spot on and accurate because, as you know, options traders love to backtest, particularly you guys that are really into the charts. How does all this fit into with what you're doing in ORATs and backtesting?
Right, so we're able to, at ORATs, we're able to take a look at the forecasts that we've made, and we have this deep history, back to 2007, and we could then make those signals and see if our forecasts were worth it. That's why we built the backtesting machine. We built the backtesting machine to show and prove to people, because you can't just say it, you have to show them with the numbers, that these forecasts actually mean something and they're actionable. And that's what we've been talking about with Joe, having actionable and tested information. This is what, even people that don't know options that well, they could speak that language. Testing and actionable information.
Yep, especially the technical traders out there, right?
Absolutely.
All right.
Absolutely.
Well, thank you both for joining us at the MarketSite today. And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.